Welcome everyone to our webinar today on hybrid mismatch rules. And as we said in some of our marketing, a lot of people thought it should be probably on the runway when you hear the hybrid mismatch. It might be to do with something in the fashion industry, but unfortunately it's catching us all out on the tax side of things as we are. And we're finding this is one area that is becoming quite topical, and hence we wanted to kind of have a bit of a chat to you all, give you some insight onto the hybrid mismatch rules and what seems to be happening at the moment. So just a bit of background. I know there's a number of you who have joined us in the past for some of our webinars, but for those that are new to transfer pricing solutions, transfer pricing solutions are specialists in the transfer pricing area, and we really focus on providing practical, proactive, and really cost-effective transfer pricing advice for all of our clients. And we have clients, we have a global network of clients, whether they be Australian-based or Asia-based, or even throughout the US and Europe, multinationals, large private enterprise. And so, half of our work probably comes from working with other accounting firms to actually help them support and provide transfer pricing services to a lot of their clients. So it's really something that we pride ourselves on, being as practical and proactive as we can with our clients. So on the Transfer Pricing Solutions Group, founded in Australia by myself, founded actually in the spare bedroom, as many of us do when we start up our business, and has grown over a number of the years. We will be actually 15 years old next year, actually, so it'll be a big 15th birthday for Transfer Pricing Solutions. We've expanded into Singapore. Our Singapore office is headed up by Adriana, and Adriana was with our Australian office for over 6-7 years, and she's been heading up Singapore now for the last about 5 years. And we more recently, in the last 3 years, set up in Malaysia and have our team in Malaysia as well. Now, unlike a lot of our, I guess you could say, competitors in this space, we do have common ownership. So we don't have all the issues that you often find with some of these other firms when you're dealing with cross-border firms. So you really get that service delivery that's quite smooth throughout all the different areas, and whether that's being services in Australia, Singapore, Malaysia, or providing transfer pricing services around the globe as well. We are very well recognised in our technical expertise and basically the contributions that we have made in this space. We were very proud of being considered a tier 2 transfer pricing practice in both Australia and Singapore, up against some really top names there. So we're quite excited, and we have been recognised with a numerous amount of awards over the years in our different areas as well. So just a bit about our background today. So my name is Shannon Smith. I'm founding director of Transfer Pricing Solutions here in Australia. We have Kevin, and Kevin is a senior manager. He has over 10 years experience, chartered accountant, and an absolute, he's our secret expert in the hybrid mismatch as well. So he knows literally those rules inside out and every sub bullet point that is in any of the hybrid mismatch rules. I'm sure he's enjoying it as well. We have Hong Chuan, who is also a senior manager, has over 10 years experience, director of our Malaysian practice, is based here in Australia. He did used to spend a month over in Malaysia and a month back in Australia, but that has all stopped over the last 2 years, obviously with COVID as well, and he is a CPA. So we're all very well placed to assist you in the transfer pricing space as well. So what we wanted to go through today, what are these hybrid mismatch rules? What are the rules? Who does it apply to? You know, how do these rules actually apply? What do we need to do when we're doing it, and how can we, help you in assessing your risk, and how can you assess your risk with the hybrid mismatch rules? Because it's interesting, it has been around for a little while, but it's really just starting to rear its head at this point. So what are the hybrid mismatch rules? Now, the hybrid mismatch rules were actually introduced in response to the OECD's recommendation on neutralising the mismatch in tax outcomes arising from countries with different tax treatments of different arrangements involving, I guess, particular types of, whether it be financial instruments or just even entities in the way it was structured. So the OECD, if we go back to the BEPS, the OECD has been focusing on a number of hot topical areas, one of those being the hybrid mismatch. So as a result of that coming out from the OECD, The hybrid mismatch rules were actually brought into, in a sense, into the Australian environment. It's Div 832 in the Tax Act there, and they apply from income years beginning on or after 1st of January 2019. Now, we're in 21, and I think for the last probably 2 years, now obviously we can write off 2021 and most of 2020 with everything that's gone on with COVID. I know the years have gone very quickly, but a lot of people are surprised to see a lot of traction now around the hybrid mismatch when it has actually been in place since the income year applying on or after 1st of January 2019. So what the hybrid mismatch rules aim to do is basically eliminate a double non-taxation. So a lot of you have probably heard, okay, when we deal with cross-border, let's get rid of double taxation. What this rule is trying to prevent is where you've got a situation of eliminating some non-taxation outcomes arising from different financial arrangements that maybe the parties have entered into, or a hybrid entity in that. So different financial arrangements. This can be where you have a situation in one country, an arrangement's treated potentially as debt in one country and maybe as equity in another country. So, you know, having one claiming the interest and the other one not recognising potentially the interest income. Could also be a timing deferral because of the different rules that they have as well. The other one is like looking at this hybrid entity where you've got a pass-through entity that in one country, and I guess it's not really recognised in another country. So this is the types of areas what that the tax office are really trying to focus on. And then it is also, the hybrid mismatch is also aiming to eliminate the double non-taxation outcome by neutralising any hybrid mismatches. So basically getting rid of it by neutralizing it, which will mean, and this is why probably we got a lot of your attention on this, potentially denying a deduction or including an amount in Australian assessable income. So this is really a big deal when you've got a company that's dealing in cross-border transactions. You do need to consider these hybrid mismatch rules. So if I go on to, so who does it apply to? So when should you be worried, or you know who is at risk? So basically, you know, any taxpayer that you've made or received a payment or a non-cash benefit under a structured arrangement. So under an arrangement, and it may fall within one of the hybrid mismatch types under Division 832. Now, we're going to go through more details on all of this. Now, it can actually be a situation that it's also whether you've been aware of the hybrid mismatch. There is in part of the PCG, and I guess going back to looking at why it's the highlight or why are people focusing on it more, there's a bigger understanding now, and I guess the tax office is out there now actually looking, hey, we've had the rules out there for a little while. Are you focusing on it? Are you doing something about it? We're now going to come in and start having a look at it. There can be situations where if the taxpayer could not have reasonably have been aware of a hybrid mismatch, and you didn't benefit from the mismatch, then it will not satisfy the condition of being party to the arrangement. So there can be some little exclusions on that side as to whether you didn't, you know, you weren't aware of it or you didn't benefit from it. Now, there's been some guidance that's come out on this, which we will go through in a bit more detail as we go through this presentation as well. Now, I'll hand you on actually to Kevin to start with the application of the mismatch rules and how do we actually look at it and try to apply it.
All right, thanks, Shannon. Look, so now we know who does it apply to and what it is. Let's look at when and how it will be applying. Now, before we go into it, just for your information, there are actually a lot of many different types of hybrid mismatch under the hybrid mismatch rules. We go to the next slide, Shannon.
Yeah, sure.
Now we have provided a list here just for your reference. We will not go into too much details about every single one of them individually because otherwise it would be too long. But we'll give you some high-level background on what they are, so you know what to look out for. First of all, you have your hybrid financial instrument. Now, this is basically hybrid arising from financial instrument dealings, like your debt and equity interests, derivative financial arrangements, any repurchasing agreements, and similar type of arrangements. So basically financial instruments. And then you have hybrid payer entity. Now, like Shannon mentioned, this is more on focusing on the entity, meaning an entity have made a payment that give rise to a hybrid mismatch. You will be captured under the hybrid entity hybrid payer entity. And then you have your reverse hybrid entity. This is a bit more interesting. Basically, what it is focusing on entities that are treated as transparent in one jurisdiction, but non-transparent in another. Now, to give you an example of this, if you look at particularly holding company based in US that has made the check the box election, what this does is basically treating the Austrian subsidiary as a pass-through entity or transparent entity, where all the income and expenses will be included in the US tax return. But in Australia, from an Australia perspective, they are still a standalone entity. They have to do their tax return, so they are not considered a transparent entity. So they will have some mismatch arising from those type of structure. Then you have your branch hybrid entity, basically hybrid mismatch arising from branch dealings. You have also deducting hybrid entity. Now, this is usually happen when you have a double deduction scenario, meaning you have a deduction that you claim for in tax in 2 or more countries. Then the next one will be the imported hybrid mismatch. This is the more interesting one and usually the more challenging to identify in your group. What this captures is basically a hybrid mismatch offshore, meaning you have 2 offshore entities that are involved in the dealings resulting in the hybrid mismatch, but you have dealings with Australia that are not hybrid related. Basically, what I'm saying that is you have a transactions with one of the hybrid entity, one of the entity with hybrid arrangement, but from your perspective, is not a hybrid. It doesn't create a hybrid mismatch. The hybrid mismatch is offshore. Okay, and lastly, you have the tax integrity rule. Now, this only applies to interest and derivative payment. Basically, it says that it captures any interest and derivatives payment that you made to a company with 10% or less tax rate, corporate tax rate. Okay, now, although it looks like there are a lot of different type of hybrid mismatch, but generally they follow quite a broadly similar concept in terms of they have certain similar criteria that they need to satisfy before you will be caught under any one of these mismatch. So if we look at that, to the next slide, there are generally 4 common criteria. You can treat this as your checklist for you when you do your annual review before your tax return. Whether or not you are reviewing your existing arrangement or any new transactions, you can use this as a guideline. For the hybrid mismatch rule to apply, you need to satisfy all these criteria. First of all, there must be a hybrid mismatch. What is a hybrid mismatch? Either you have a deduction not inclusion outcome, or you have a deduction outcome. And then you have to be it has to be between members of the same division, the 832 control group, they call it, which we will go through what that means, and then you would be parties under a structured arrangement. So if all these 3 applies, then you will be caught under the hybrid mismatch rule. The last one, it only applies to financial instruments. It basically means that the transaction have to be between related parties. It is similar to the division control group, but the threshold is a bit lower, which we'll go through later on as well. So let's look at your first checklist, your first sort of red flag, right? The hybrid mismatch. What does this mean? Go to the next slide, Shannon. Okay, hybrid mismatch, like I said, 2 situations. You have a deduction non-inclusion mismatch, or you have a deduction mismatch. Deduction non-inclusion basically means when you have made a payment and you have claimed a tax deduction in Australia, but this deduction, this payment is not included as considered as tax income in another country. to work out when you're working out deduction non-inclusion mismatch, just bear in mind it does not include any deduction that you've made that is attributed solely to foreign exchange fluctuation, meaning your FX loss. Okay, for a double deduction or deduction mismatch circumstances, this basically means that you have a payment where a tax deduction was claimed in 2 or more countries. Now, payment for this mismatch doesn't have to only be from acquisition of service of tangible products. It can also be deduction that you claim for depreciation or net loss of partnership. Okay, so this usually is your first go-through criteria when you review your tax return. When you have something like that, then you need to consider whether or not you meet the other criteria to decide whether or not you have a hybrid issue. The next one will be the control group. What is considered a control group? It is basically if you are an entity, if you are a member of a consolidated group for accounting purposes, you will be a control group for hybrid mismatch rules. If you're not if your group doesn't consolidate for accounting purposes, then you can also be considered a control group if you have a 50% or more shareholdings in the parties that you're dealing with, you're transacting with, or the other way around. If that is not the case, you can also be a control group if you are both under share the same shareholder ownership or shareholder, which has 50% or more shareholding in your companies. Okay, so that's the second point. Now the third one will be a bit difficult to actually check, which is a structure arrangement. One of the criteria in the hybrid mismatch rule is that you have to be considered operating under a structure arrangement. All right. In the rules, it says that structure arrangements basically means that your transaction, you have priced in the hybrid mismatch into your terms of the scheme or your transactions. If it's not the price, then you might have already have hybrid mismatch as a design feature of your structure. Now, this can be very subjective argument. So the ATO actually has released some guidance on this and to provide taxpayers a bit of explanation of what they see as, you know, price into the terms or design features. So from that, we can see that the ATO says, you know, when they're looking at whether or not the hybrid mismatch rules is hybrid mismatch benefit is priced into the terms of the scheme, they can look at whether or not your structure or your transactions have any mechanics or terms and conditions that allows any of the parties to either be compensated extra or leave the transactions when the hybrid rules benefit is not being realized. So for example, it's more like a contingent clause saying that if I put this structure into place and for the purpose of getting hybrid mismatch benefit, for whatever reason, I can't get it because of another factors, then certain parties can get out of these transactions. That is basically what it means. Second one is the design features. Now this is a bit more challenging. ATO can look at your structure and see whether or not your intention is for the structure is to get your the hybrid mismatch. They might go as far as going to looking at whether or not you have obtained external advice, either written or orally, when you are in the planning stage of setting up the structure to build the hybrid mismatch benefit into the structure. So that's the structure arrangement. Now the next one, now this is more relevant, this is only relevant to the financial instrument, which is the related parties. Now, if you remember earlier, you have to be in the control group. If you're not in the control group, then you will not be subject to the hybrid mismatch rules for most of the hybrid mismatch type. But for financial instrument, they actually lower down a little bit for the threshold. What they say is that you have to be either a part of the control group. If you're not part of the control group, the shareholding from 50%, if you're in a control group, is reduced down to 25%. So it's a lower threshold. So these are the few factors that we think you should look at when you do your review annually. And what happened if in the case that, after you do your internal review, you say like, oh, maybe I have a hybrid issue. I want to understand what is the tax impact. Now, this will be included in the next section. I'll pass it on to my colleague, Hong Chuan, that will go through what are some of the tax impact, financial impact. We go through some case studies with you, which provide a bit of a hybrid related issue on the common structure related to tax haven. HCU, do you want to take over?
All right. Thanks, Kevin.
Thanks.
Now that you guys have a general idea on what a hybrid mismatch is and its application, it's crucial to see how does a hybrid mismatch impact your company or your clients, right? That's the more important issue. As you know, Australian taxpayers caught under the hybrid mismatch rules or deemed to have a hybrid mismatch during the income year that you can get your tax deduction denied in Australia. Right? If you have a deduction non-inclusion scenario, DNI scenario, incurred offshore, meaning deduction in foreign tax jurisdiction, but not taxable in Australia, and that the foreign country does not have a hybrid mismatch or similar ruling in place, then the ATO may include that hybrid mismatch amount to your Australian taxable income, right? And on the other hand, if you have a double deduction DD scenario, then the ruling will act to deny the tax deduction in Australia up to a so-called neutralizing amount, right? So what this neutralizing amount means is the amount that gives rise to a double deduction scenario. For example, if you have $100 tax deduction claimed, that neutralizing amount starts at that $100, right? But having said that, however, the neutralizing amount can be reduced by the dual inclusion income, right, to a maximum of nil. So making sure that you're actually denying zero deduction, right? So the dual inclusion income means where you pay your tax for the same payment in two different jurisdictions. So you have one jurisdiction paying taxes and sort of a double taxation scenario, then you can use that as an amount to actually reduce the neutralizing amount to zero, right? So if you look at the tax impact that we are going through here, you either have a reduced tax deduction or an increased accessible income, resulting, either way, it results in additional tax payable, right? Which is obviously something that you need to avoid, right? So basically, what you need to do is look at the tax impact, and let's look at how we could assess your risks and manage any potential hybrid mismatch exposures on the next slide that we're going to go through. Now, in practice, we ourselves have experience with our clients, with a few of our clients where there are many challenges to the taxpayers in actually identifying hybrid mismatch arrangement within their group. Right, there are a lot of, because the awareness is not there and it's new to a lot of taxpayers, where even your headquarters would not have any idea what a hybrid mismatch ruling is, right? Especially if you're a smaller subsidiaries with a large multinational with complex structures, right? There are circumstances where access to that group's real party dealing structures is actually not readily accessible to the Australian subsidiaries due to the size or due to the communication within your group itself, right? And with the lack of awareness from your top approach, where you have your headquarters not knowing what a hybrid mismatch is and they're not aware that such rules applies, then it actually leads to a lack of internal control and group policies to actually first identify hybrid mismatch, or rather hybrid arrangements, and then ways to actually mitigate and manage that hybrid arrangement so that the group as a whole will be able to manage your hybrid mismatch accordingly, right? So as it's relatively new, not all countries actually adopted the hybrid mismatch rulings. So there may be some timing differences between the Australian subsidiaries and your headquarters jurisdiction in terms of implementation of the hybrid mismatch rulings, and causing the headquarters to reluctantly perform any analysis on their end to look at hybrid at this stage, right? So as Kevin has gone through earlier, there are a list of hybrid arrangements out there, and in particular the ones with imported hybrid mismatch, where on the Australian side, at first glance, you would think that you're safe, that you're not under any hybrid mismatch rules, but you wouldn't know where the imported offshore hybrid lies, because that's where headquarters will have an overview of that arrangement and not on a local point of view. So with all these challenges, how can you as a finance manager or accountant mitigate the company risk in relation to the Australian hybrid mismatch rules, and show that you have you have done your due diligence in identifying any hybrid mismatch hybrid arrangements within your organization, right? Especially if the hybrid, as I said earlier, is actually imported, right? So when you have an imported hybrid mismatch, therein lies the communication between the Australian entity and your headquarters to actually discuss and identify any imported hybrid mismatch that has occurred within the group itself, right? And good thing is, for this matter, the ATO has actually introduced or released a draft practical guidelines 2021/D3 that provide a guidance to taxpayers to actually self-assess their hybrid risks in Australia, and which we are going to go through on the next slide. Yeah, thanks, Shannon. So basically, for this PCG, it sets up an approach from the ATO's point of view to assess whether a taxpayer has undertaken a reasonable inquiries in relation to imported hybrid mismatch rules. As mentioned earlier, imported hybrid mismatch is actually one of the key issues that our client has faced, right? Your miscommunication and lack of manners, and reluctant to actually share information from headquarters point of view. So because the headquarters does not have the awareness on how it impacts the Australian point of view, and actually as a group as a whole in terms of tax, right? Where you have imported hybrid mismatch that may link back to Australia, right? So this PCG is actually very comprehensive, and we will not be able to go through it every single detail today, but we would actually highlight some of the key aspects in this PCG, which could help you as a person in charge to actually self-assess your risk and potentially put a system in place to mitigate your hybrid risk in Australia. Now, there are two approaches that ATO has provided us. One is a top-down approach, and the second one is bottom-up approach. Right? For the top-down approach, as the name has suggested, this approach involves getting information and assurance from your senior management of the group that there is no hybrid arrangement within the group that has linkages back to Australia, right? If its circumstances arise and communication between you as an Australian entity to your senior management, that there's a open communication in place, then the top-down approach would be recommended, right? Generally, this involves obtaining the core information from the head of tax, from the group itself, and then for yourself to perform a self-assessment of whether such information shows any potential hybrid mismatch that will be subject to hybrid mismatch rules in Australia. So if you actually have identified such arrangements that are in place, then first you need to determine whether the type of hybrid mismatch that you are dealing with and the volume of transaction that they are looking at. As for the bottom-up approach, then obviously it comes from your local jurisdiction in Australia. Then you have to identify any cross-border transactions between Australia and the group can be subject to hybrid mismatch. So I guess the first step would be looking at your ideas. Look at what reapply transactions that you have and look at whether that particular transactions have any impact from the rulings. Then reach out to the tax personnel in that counterparty jurisdiction. Right? For example, you have transaction with US, talk to the US tax accountant and understand what's the tax treatment in their jurisdiction for the respective transactions. So in that case, you'll be able to sort of identify whether there's any hybrid mismatch going on for that particular transaction, right? Once you have obtained these transactions, then you can sort of evaluate whether hybrid mismatch has occurred or arisen, right? Regardless of which approach that you adopt, we recommend document the whole process in detail to show that reasonable effort has been made to self-assess for risks. So that's very important. Similar to other self-assessment tools provided by the ATO, this PCG also includes your traffic light section explaining how taxpayers can use these guidelines to self-assess their risks with regard to the ruling, and then they have provided a so-called low risk zone, which is a green zone, where you need to have performed your due diligence in the first place using the ATO's recommended approach, either the top-down or the bottom-up approach, and have evidence to demonstrate that you have gone through all the processes in place, and there is no offshore hybrid mismatch within your Div 832 control group, or all your offshore hybrids that have been identified have been neutralized by the relevant sections of the rulings per se, right? And of course, there's one more thing, that you may also fall within the low risk green zone if you can demonstrate that you have insufficient info to determine the imported hybrid mismatch application, and you have not sought to claim a deduction for the payments made to members of your Div 832 control group for that particular transaction. Obviously, then that's basically means that you're doing ATO's job by denying your tax deduction for them, right? So now that we have gone through the facts of hybrid mismatch, it'd be great if you could illustrate this through a case study on how it applies, right? So, okay, for this case study, it's one of the few legacy structures that we have experienced, and it's a pretty common structure put in place for at least the construction industries. For background for this case study is that it's a public investment fund from overseas wanting to invest in real estate development projects in Australia. Right, that's a standard practice in the investors' countries to set up such structures and regulated by the local tax authority. Now, this structure is actually set back in 2016, so way before the introduction of this hybrid mismatch rulings. And the fund set up a special purpose vehicle in the Cayman Islands, tax haven, which provided intercompany loans into two separate Australian subsidiaries, of which it has 20% shareholdings, to fund the acquisition and develop the land into residential properties. Obviously, the intercompany loans provided to the two Australian subsidiaries were priced in accordance with the arm's length principle and, of course, in accordance with the Australian transfer pricing regulations. Right. As you all know, Cayman Island is a tax-free jurisdiction where interest payments from Australia to Cayman will create a deduction / non-inclusion, so your DNI inclusion, where it will be deducted in Australia and not taxable in Cayman, right? So at first glance, many people would jump into the conclusion that this will be caught under the hybrid mismatch rules and have the deduction in Australian denied, right? In fact, we actually have a lot of queries from our client on this point alone, and that they are worried that some of their legacy structures which are put in place, similar to this case, would have given rise to a significant tax and TP risks in Australia because of the hybrid mismatch rules. However, as Kevin has discussed earlier, there are some criteria that need to be met for the hybrid mismatch rules to actually apply, right? So the very first step you need to do is gather the facts that you can obtain, then look at the fact pattern through those facts. Next, you need to determine through those facts whether there's a hybrid mismatch that applies, right? So the rule states that there must be a mismatch in the treatment of debt interest. Well, to be clear, this does not necessarily mean the difference in tax outcome of the debt interest, whether it is deductible in one country and not taxable in another. It actually looks at from an income tax perspective. Does both jurisdictions treat this as a debt instrument in the first place, as Kevin mentioned earlier? In this instance, both Cayman Island and Australia would have treated this as a debt instrument, even though the interest income is not taxable in Cayman Island, right? An example of where treatment would be different is where you have a redeemable preference share, where such instruments may be treated as a debt in one country and treated as an equity in another. That's where it would be different. Next, then we have to look at whether the intercompany loan were made between related parties as defined under the rules, right? On this point, as Kevin has gone through earlier, the rules define related party as either you're under a same div A32 control group or entity with at least 25% or more shareholdings. For this structure, we know that 25% shareholding is not relevant, as Cayman Islands only owns 20% of the Australian subsidiaries. Then obviously then you have your 832 control group that you have to satisfy. So as Cayman SPV, it's not required to actually prepare a consolidated financial statements for these operations under the Cayman Island law, the local law. Then it's not likely for the SPV to actually consolidate the financial statements for the subsidiaries for accounting purposes, right? Hence, the three companies will not be considered to have met the definition of the A32 control group, right? So it's like a step-by-step process that we have to go through to make sure that whether hybrid mismatch applies, right? Then lastly, the last step would be to see whether this loan is actually structured under a structured arrangement. So for structured arrangement that applies, as Kevin has gone through earlier, it's either the hybrid mismatch needs to be priced into the terms of the intercompany loan, or it's reasonable to conclude that the hybrid mismatch is a design feature of the structure. Right? We know that there are actually challenges in, to actually satisfy or justify whether they actually met these two criteria, right? So, and for this point, we will have to see the pricing of the intercompany loan, where it actually was set in compliance with the Australian TP regulations, and there's no additional compensation provided to either the Cayman or the Australian subsidiaries that take into consideration any potential hybrid mismatch benefits, right? That's the first point. And then the structure was regulated by the local tax authority in the investor's country and was put in place long before the hybrid mismatch rules was introduced, right? So the second point is design feature, right? Therefore, it's not likely that any hybrid mismatch was put in place or is a design feature of this structure, right? So if you look at this case study, even though the intercompany loan transaction may have resulted in a DNI scenario, but once you have gone through the steps for the application, then you'll be able to actually identify that it's actually not subject to the Australian hybrid mismatch rules, right? So to conclude this, as mentioned earlier, it's very crucial to actually gather all the facts beforehand, a bit from your tax personnel, and then from the respective tax accountants from your different jurisdictions, and then put all the facts in place, and then assess and evaluate whether you have any arrangement that falls under the hybrid mismatch rules, right? So once you've gone through that, you'll be clearer as to whether it actually applies to your transaction. Now that we have gone through the hybrid mismatch rules, I think, Shannon, it would be great if you could share with us the key takeaways for today's session.
So I guess thanks for going through all of that, Kevin and HC. And as HC's gone through the case study, you know, one of the key things about the hybrid mismatch, and if you're sitting here on, you know, on this call as either an accountant advising clients, the public officer signing off on the tax return, or the finance manager, it's really important that you actually go through and perform a thorough review of your cross-border dealings and structure to understand about the hybrid mismatch. Now, our experiences at the moment, Australia did introduce the rules in a sense very quickly. Australia is well known for doing that. When the rules come out with the OECD, we do tend to jump onto them very quickly, unlike some of our other countries around the world. And what we're finding is a lot of those that we're working with here, foreign subsidiaries, often the finance manager or the public officer here in Australia is kind of putting their hand up to the parent company saying, hey, we have this hybrid mismatch issue, which actually at that stage on the other side, they haven't been focusing and considering on that. So it's really important to do a thorough review. And I say that also from the perspective, you've got to answer the question in your tax return. Now, maybe when you're filling in the tax return, it kind of defaults to no, it's in the international dealing schedule. You need to make sure you've considered it, because you are lodging a tax return and the public officer is saying, actually, this tax return is correct when I'm lodging it. So make sure you've done your analysis. I also say, just from a perspective of being able to cover yourself and make sure that you have asked the question up through the parent entity, because whether it's a financial situation like the case study we've just gone through, or whether you're actually a foreign distributor here in Australia, and we have actually one that, you know, is subject to the hybrid mismatch, and, you know, and there were some challenges around that. The US is a very prime example of where you've got to be focused and making sure, because of these check the box elections that they have, it can actually mean that we have a situation where potentially the transactions not being recognised on the other side. So make sure you do your review, and it could be, and you can go through the PCG, it can just be going through up the chain, up to head office as well, making sure you're getting the answers from them. Don't jump to conclusions. We've seen many transactions. I guess what we've had is we might have someone contact us and say, hey, I want you to do some transfer pricing. We look at their structure and say, we need to check the hybrid mismatch, because if we can't get to first base that you're okay from a hybrid mismatch, it doesn't matter what our transfer pricing says if we can't get across to first base. And we've had a few situations, you know, ourselves where when we've looked at the structure at a high level, we've been concerned from a hybrid mismatch perspective. As we've gathered further information, even ones that we've actually thought were still potentially potentially a concern, and we've got all of the information. We even had just last week a really great session with the key people that wrote the PCG, et cetera, at the ATO last week, to really go through, I want to know names, with a client, and had a great outcome from that one, because they were satisfied also that this client was not under the hybrid mismatch. So, and then start to, I guess, establish, it's going to be another one of those layers of compliance that we just all seem to keep getting more and more and more. But as a multinational company, you know, a company dealing with cross-border, it's one of those necessary evils, unfortunately. So just establish an internal process to make sure you can identify and mitigate the exposure to it, whether that's head office helping. I think you'll find head office will get a bit more involved in it as the hybrid mismatch start to come into play in their countries, and then really making sure you ensure you've got sufficient evidence and documentation, so that if you do get the tax office coming in and wanting to have a look at that situation, you've already got the responses from head office, and making sure that you've had them engaged early on. If you do need any assistance with evaluating it, we can actually, how we can help, and we've been doing a number of these recently, is just kind of doing a risk assessment on the hybrid mismatch exposure. Do you have an exposure If so, can we mitigate it? Are there other things that we can do to be able to help you around that? And maybe it's on the structuring, an estimate, preparing an estimate of kind of the financial and tax exposure from the potential hybrid mismatch. Assist with an ongoing ATO review if you are getting any questions coming through, and this planning and restructuring and implementation to mitigate the hybrid mismatch exposure, because often a lot of these are not set up originally with that in mind, but we may have this exposure, and then obviously transfer pricing documentation to wrap it all up from a penalty protection purposes. Now, thanks very much for the feedback. We've got a lot of great feedback on last time's webinar on sessions that you would like us to actually present on. So thank you very much for that. We're actually going to do a session coming up on transfer pricing methodologies. So what are the different transfer pricing methodologies? Sounds really simple, but the number of times we see confusion with people how they're filling it out on the international dealing schedule, how they say they're implementing it from a day-to-day perspective. And so this is one that comes back. So it's going to really be a TP 101 on what are the transfer pricing different methodologies that we tend to use. There'll be other updates. I know we've had a lot of people wanting also to look at how do you do a TP calculation when you get to the end of the year and you've got to make sure, and do your invoice for the intercompany. How do you do that? So that'll be one of our next ones coming up as well. So we'll open it up now to any questions. Whoops, I've jumped for one. We do have, now we have a questions that's come up. Oh, I've got thank yous in the chat box. Thank you. So we have one question. How does an Australian cost plus service entity of a US company get taxed in Australia when they have ticked the box? Please explain the denial of the deduction and the dual inclusion of income with respect to the intercompany invoice. Actually, Kevin, that might be a good one for you. You can say that's one that we actually had a similar client with that situation just recently. Have you got that? Yeah. It's in the chat, Kevin, not in the question.
Yep, I've got it.
Yeah. I know you know which client I'm thinking of, don't you?
Yeah. So there are a few parts to this. When you have the check the box in play arrangement in place, first of all, the deductions that you're claiming here, although might not be included because it will disregard the intercompany arrangements, but the deductions for other stuff, especially third-party arrangement, will be first of all deducted here, and then it will be also deducted in the US. So they will have a sort of the double deduction. But usually in this situation related to check the box, there are usually quite how do you say, a leeway to it, because in this type of structure, usually you will have paid your income tax in Australia, but you also would have paid an income tax in the US. Okay. So that will then create what a scenario calling the which is called the dual inclusion. So under the hybrid mismatch rules, yes, you might get a deny in deduction because you have a double deduction. But because when you have a double deduction, in the rule says that you will potentially have a neutralizing amount up to the deduction that you have claimed, meaning they can deny 100% of the deductions that you have there. But because you have a double inclusion, the double inclusion can actually reduce the neutralizing amount up to a maximum of whatever deduction that you're claiming. So if you are paying income, including whatever income that you have in the income tax of Australia and US, then potentially your dual inclusion income will offset your double deduction denial. Does it make sense?
Yeah. And that'll go into your international dealing schedule. You'll be responding with those answers.
Yeah. So in terms of international dealing schedule, you will still declare that yes, you have this situation, but you will not have a neutralizing amount because you have already reduced it to zero because of the dual inclusion rules.
Yeah, and that's where being able to articulate that, and this happens in a lot of different tax areas, but when you go to your parent company and asking that question, if you need some of that wording or if you need that discussion, we've often found, obviously people shoot off the emails, but having that phone discussion as to what's important, why are we looking at it, and what is the answer we're trying to get, just to make sure. And I know in this situation, originally when we were asking the questions and the client was going back to their head office, I think there was a misunderstanding going back up to the head office. And so once we spoke to head office and look at what we're trying to achieve and what we're hoping to see, that made that a lot clearer. So we didn't, so whilst yes, there was an issue, we were able to resolve it on the other side, and we didn't have a risk from that perspective. But yeah, that's a really good question. I think that's going to come up a lot, and it won't be always the same. Not every single one of those clients are going to be okay in a situation like what we had with this client. Yeah. So how, what if you are not required to fill in an IDS? How would you need to address it? Well, the rules are still going to apply. It just means that you haven't had to fill it out in the tax return, that then the ATO has that information on it. So I'm assuming with the international dealing schedule, so basically you've either got cross-border 2 million of transactions, but don't forget, and I see this happen a lot to do with the international dealing schedule, a lot of people forget to add the actual debt balance as part of that, adding up towards the 2 million. So just making sure that you've got that. But that's the only field at this stage. But you are actually, in theory, supposed to consider all the different tax rules. You just don't have to actually lodge the international dealing schedule if you haven't satisfied the criteria that's required. Did we have any other questions? Anyone got any other questions? I know it is quite a complicated area. The PCG, I'm quite a big fan of the PCGs that the ATO is bringing out at the moment. If you can be a fan of them or excited, I do quite like the traffic light situation and being able to go through that process. It kind of gives us a bit of a cheat sheet as to, well, what are the ATO going to be focusing on? How can you, in a sense, self-assess and get yourself into the green and into that comfort position, or know when you've got an issue if you're in one of the others. So as more of that kind of comes through and that gets finalised, we can see what comes out on that. We will be recording, or we have recorded today's session as well. I can guarantee it's better than Netflix. You can go on and like and subscribe to our YouTube channel. But we all of ours, we do a lot of, we've got a lot of presentations going on at the moment in Malaysia with the rules fairly, the transfer pricing rules fairly new, or I guess a lot of changes going on, especially also in Singapore and again in Australia as well. So if you aren't finding the Netflix programs any interesting anymore, you can subscribe to ours and put it on the big screen as well. But if you do have any other questions, feel free to reach out. I'm happy to help, and thanks very much for joining. We'll see you at the next webinar on transfer pricing methods, and if there's any other practical topics you'd like us to prepare a webinar on, we're happy to have a look at it. Thanks very much.
Thank you, guys.
Thank you.
Thanks.
Yeah.